stocks our strategists feel are poised to deliver positive returns are featured now in their top stock picks of the week.
Medical technology company and an automaker are on this week's list of top stock picks. Our strategists Kevin Cook and David Bourne paying a visit to the desk here. Going to fill us in on each one of these. Kevin, we'll start with you. Medical technology company Inogen, providing oxygen to people.
Yes, you can't live without it, right?
Yeah.
And their motto is oxygen anytime, anywhere. These are the portable oxygen concentrators. You may have seen their ads on TV. Now, as you know, I run a healthcare portfolio here, and I don't just pick biotech stocks, contrary to popular belief. I like to look at the medical devices, instruments, products, what generally goes under the banner of medtech, medical technology. And this is an incredible story. Take a look at my website here. I'm showing their website on my screen for Inogen. POC, again, stands for Portable Oxygen Concentrator. And this photograph pretty much sums up what they're all about. For people who need to carry oxygen, do you want to carry a heavy tank around or this portable device in a satchel of some kind that weighs 3 to 5 pounds, depending on how many batteries you have. And it's bringing in fresh air, purifying it, constantly available because of the way the technology works. So the company has grown like gangbusters lately. It also provides nitrogen. I'm going to show some other slides in a second. This is from a company presentation. I just want you to see. So how much does it cost? Well, they range between $1,500 and $3,000, and you're seeing a couple of models here that are in the $2,300 range. And they just blow away any comparative solution because of the portability. And you can get up to 10 hours of battery life. If you see my slide here, if you use a double battery, you can get up to 10 hours of battery life on some of the more advanced models. And they have a 5th generation coming out. So what's important, this company is trading at over 90 times EPS. So not something you want to rush out and buy unless you understand the story. I actually owned it a year ago, and we made about 50% on it, and I sold it when the PE was still 90 times. And I thought, well, it's growing 20 to 25%, but I don't know if I can pay 90 times for it anymore. Let's just take our money and go. So I sold it at 120 bucks, and the stock has just soared. I mean, it's almost tripled. It's come back quite a bit here, down back under 200. And why would you consider it here? Because of these growth rates. The analysts missed the story. They didn't understand what was going on. So let me show you a couple other slides from the company that will put things in perspective. So this is a very large addressable market. There are anywhere between, say 3.5 million patients who have COPD, and that stands for chronic obstructive pulmonary disease. There could be as many as 4 million patients by next year, but the company also thinks, according to their research, that 50% of COPD patients are currently undiagnosed. So this is a very large addressable market, and that's why they put up the kind of growth numbers they have. You can see if they grow into the market, they can take away, they can earn 50% market share as they grow into it. And international is great. Their compound growth is 47% because you're talking about a company. So when I owned it over a year ago, analysts were looking at, they're going to, maybe they'll earn $275 million for 2018. They're topping $350 million this year. So analysts have been behind the story. I think part of the reason is that the company's direct-to-consumer model is working so well. They're advertising on TV. You've probably seen the ads. You hear, like we hear COPD. We don't even know what it stands for unless you know somebody who's on oxygen. But going direct-to-consumer obviously raises their margins, right? And so let's look at the estimates. Well, I mean, here's no chart we have tells the story better than the Zacks price and consensus. So you can see over time what the estimates have done, and you can see. So here I am thinking this is a genius trade. I'm selling the stock right before November earnings last year, and then it ramps up. Estimates ramp up into 2018, and they just keep soaring here. So the company's going to make over $2 this year, and estimates are still low for next year. So that's why. So I just have to show you. I I just have to show you the estimates because they report tomorrow, and so this is key. They report Tuesday after the close, and next year's estimates don't really show any growth because they're waiting to hear what's the outlook. What is, are they still penetrating the market the way they thought they were? So I've got to go to my detailed estimates page is what I want here.
Tomorrow's Tuesday, November 6th,
Yes.
by the way. People are following along.
So look at this fantastic revenue growth here, 40% this year to $350 million. Still looking at almost 23% next year to over $425 million. But the EPS is still real low. They're only looking at 5% growth. I think that will change tomorrow after we hear from the company and, what is the outlook? What's the ratio of direct to consumer versus business to business and wholesale? So I think with the pullback, the 35% pullback you've had here in the market, in lots of stocks, right? Or, especially in med tech and biotech, this is one you want to look at because it could be an acquisition target too for somebody like a J&J. I'm not saying that's a rumor or anything, but at a $4.5 billion market cap, trading under 10 times sales, it's a unique med tech story that is going to capture 50% market share.
And it's been outperforming its industry.
Absolutely, yeah.
So
that's why they pay the premium multiple.
Sure.
All right, David, you're looking at Tesla.
I am. This is one of my favorite companies to discuss because it is. It's such a rich subject. It's like an onion. You start peeling it, and there's just more and more and more there. As compared to, for instance, a big company like Apple, right? 20 times the size of Tesla, but it's very, very easy to understand Apple's business. They have a few very well understood business units. Analysts don't generally have a lot of difference of opinion going into major events for Apple. It's boring in comparison to Tesla. Tesla has all sorts of things going for it, and just recently turned the corner with the best quarter they've ever had by a wide margin. They were able to deliver more than 55,000 of the new Model 3 mass market car, and significantly, they're selling them at really attractive prices, close to $60,000 average a piece for a car that was originally advertised as being as inexpensive as $35,000. Still a ton of demand for it. They signed up 450,000 people who plunked down a deposit for it. The majority of those people are still on the list, so they've put out 55,000 this quarter, and if they can keep producing them, it's conceivable they're going to continue to sell that many or more for the foreseeable future. And then the really important thing is that they, for the first time, first of all, they blew away revenues, over $6 billion in revenues. Estimate was 4 or 5.7 something. They were cash flow positive and net positive for the first time in a very sustainable way, or an apparently sustainable way. And for the company, this is significant because they've got a pretty big debt load on their balance sheet, over $9 billion of debt. And there was previously a lot of concern that as some of this debt comes due fairly soon, they were going to have to raise money, either through a convertible debt offering, which was going to be fairly expensive because they didn't have a great credit rating. They've been downgraded a couple times, specifically because of this balance sheet situation, or some sort of equity offering that would dilute current shareholders. The results from this quarter seem to indicate that they don't have any immediate need to raise money. They'll be able to service that debt simply out of operations, which is a really big deal. Was a massive weight lifted off the stock. So what I want to look at here is just a little quick analysis of how they got there this quarter. So if you look at my first picture here, just a table about how many Model 3s they've produced in the 5 quarters since they've been producing and selling them. And if you look at the numbers, it started as just a little trickle, and thanks to some pretty significant efforts in increasing production, a lot of painful ways. That's been well documented. Elon Musk called it production hell for a little while. It's now a flood. They're getting out over 50,000 cars a quarter. And just to put that in perspective versus similar automobiles that their competitors are selling, on the right here you can see unit volume for car sales in the third quarter. And the Tesla Model 3 was the 5th largest car by unit volume in the quarter, and behind only the tremendously popular cars from Toyota, Camry, Accord, Civic, and Corolla. So that's a pretty big feat to go from 0 to the 5th best-selling car in that short a period of time. And then on the left side there, this is even better, you'll see that the Model 3 had the highest revenues, even at 5th place, still 50% higher than the Camry or Accord, because of that high selling price. Right? There's a perception of quality, it's high technology, it's sexy and desirable, and people are willing to pay a premium for it compared to other comparable automobiles. Right? So I think Tesla's managed that very well. They started as a car that was aspirational, desirable, and they've kept that brand cachet as they become able to produce more mass market cars. Again, $60,000 is not an inexpensive automobile, but compared to the Model S and the X that they've been selling for typically over $100,000, it's a lot more accessible to a much bigger market. Couple little events that are happening. So again, earnings have passed. We won't get another earnings report out of them for almost another quarter. There is going to be a big management change. As part of his settlement with the SEC about his funding secured tweet debacle, Elon Musk is going to be forced to step down as chairman of the board. And they've been, his last day that he can serve as chairman is next Tuesday, the 13th. Tesla's been very tight-lipped about who they're considering. It was the only question that Musk didn't answer at the investor conference call. So he was in a very jovial mood. He was reporting a great quarter. He was pointing out some safety issues and design issues that he thought were positives, and in general took every question happily. And then when someone asked him about what does the chairman's search look like, he said, I'm not answering that. Here's what I'd like to see. I'd really like to see someone from the auto industry. Elon Musk is undeniably genius and has been the driving force, especially creatively, in this company, but also seems to have gotten very, very good at solving production issues as well. But he's not really a car guy or a finance guy. He tends to fly by the seat of his pants. Some of the things he says seem to have a certain amount of bravado or emotion to them, and I want to see someone who's a more nuts and bolts finance person, understands the auto industry. A good example is his claim, which he's now been able to back up, that he didn't have to raise cash this year.
How difficult would it be to find somebody in the auto industry, however, who shares the same vision for these cars?
I think it probably just got easier because now they look more like a regular company. They're selling high-quality cars. They're selling them at a good price. They got a nice margin on them. You no longer have to drink the Kool-Aid the way you did 2-3 quarters ago and think I can turn this into something that works. It's already something that works, but it needs someone who's going to make, for instance, a cash raise decision as a financial decision, right? You look at it, your options in the market, you look at the cost of debt financing, you look at the potential dilution of equity financing, and you make a rational quantitative decision about whether you need money or not. This is not an ego thing or an emotion thing. This is just a numbers thing. So I'd really love to see a numbers guy. A good example is Alan Mulally, been CEO of Ford and Boeing. So these are technically very similar businesses in a lot of ways, and tons of experience, but in a very business-like, low-emotion way.
Would a car numbers guy scrap the whole integrated energy company with the solar roof tiles to charge your car in your home?
You know, it's funny you mentioned that. I believe that even Musk is sort of backburnering the whole energy generation thing. I think that the cars are working really well. If you look at the revenues, and they basically run the energy business for about a scratch. It supports itself, but it is not a profit center for the company, especially now that they're making this many cars.
I mean, it costs $100,000 to put that roof on, right?
Right.
Those tiles and.
it's really high-end stuff. It's great. It's interesting technology. It's beautiful to look at. It's an excellent idea. Yeah. But for right now, I think that, that's going to be backburner at Tesla for a while. The numbers don't work yet. One last little thing I want to say about Tesla. There's, when you purchase a Tesla, you get the option to buy the enhanced Autopilot system, which is essentially a suite of hardware. It's the sensors and the cameras for Tesla's enhanced Autopilot. As it stands right now, when you're using enhanced Autopilot, it's a high-tech cruise control. It's got some convenience factors. It's got some safety factors that help you avoid accidents. They call it active collision management as opposed to passive, which is how safe is the car once you've been hit. This tries to keep you from getting hit. It's pretty neat stuff, but the real promise of it is that hardware will be able to be turned into fully autonomous driving capability at some point in the future. That's really the main goal.
With a software upgrade,
exactly.
Right? You buy it now, the hardware's in place, you just plug in.
You got it exactly. So you have to buy the hardware now, and you have to be confident that eventually they're going to have the autonomous software available. When it becomes available, right now they're estimating it's going to be a $3,000 upgrade. And they have warned that that price may go up. So if you want to lock it in now for $3,000, you can have it when it's ready. If you want to roll the dice and wait till it's ready, it could cost more. But in my estimation, if you look at the chart, 61% of Teslas on the road now have the hardware for autonomous driving. That is 240, 250,000 cars. The development cost of that software is happening right now. Right? So if you look at the R&D budget on the income statements that we see today, some of that R&D is that autonomous software. When it's available, my assumption is that the actual administrative costs of doing the download are going to be fairly small. So all the $3,000 that they can get from people for that software download is going to be very, very high margin income at some quarter or a number of quarters in the future. So there's this Easter egg, essentially, out there potentially for Tesla to have a significant increase in revenues when the Autopilot software is available, having already paid for the development of it now.
And maybe a quick flip to profitability.
Sure. Well, it seems to me, and the auto business is very cyclical, right? The economy goes south, the first thing people put off is buying a new car. One of the first things they put off, right? That's an easy decision. And so automakers typically have that risk out there that in an economic slowdown, they're going to have some rough times. If you discount the possibility of a significant recession in the U.S., Tesla really appears on their way to being net profitable going forward, with the possible exception of a period when they've got a big piece of debt to service. They're sustainable now. They're flying.
All right, I think we're coming up on time here.
Yep.
Either of you own either of these?
No.
I do. I own Tesla. I own Tesla call spreads. And in total full disclosure, I own one of the cars too. So I'm about as long as I can get on
That's
this thing.
why you were doing the commercial for them. All right, don't forget more stock information always on our website, Zacks.com. Get over to the homepage and check it all out. With Kevin and David, I'm Terry Ruffalo.